So CVP analysis means cost, volume, profit analysis. So main takeaway from CVP analysis is you will find out your break even in varying conditions. Why CVP analysis is used? First is, like I told, it is required to find out break even. So CVP analysis is done on a graphical method, but it also can be calculated. But in graphical method, you will have an intersection point of cost and sales. That point intersection, when you project it on your x-axis, you will get units, y-axis you will get cost. Then you can visualize how changes in variable cost or fixed cost or selling price will affect your break even. Then it will also help you to understand what product mix is giving what break even. But there are certain assumptions which are made under CVP analysis. What is it? One is the constant selling price. So this assumption may not be always true. So if I'm getting a bulk order, there will be some discounts or economics of scale will apply. So my selling price will vary. And the same thing is applicable for variable cost per unit also, because I'm getting from my suppliers. So if I'm doing bulk purchase, I will get some discount. So variable cost per unit is also not constant. Next, total fixed cost remains constant. So fixed cost, there is some level threshold to which it remains fixed. After that, it may change. So it may also vary in ranges. So that is also a possibility. So for CVP analysis, these assumptions are made. The cost and revenue are linear in behavior. So that means they are a straight line. They may not be a straight line in reality. So it may be a curve. It can be an exponential curve. If you buy one phone, it will be 1 lakh. But if you buy maybe 1 lakh phone, your cost will go to maybe around 65,000. So they do not behave in linear, but for CVP analysis, such assumptions are made. Next assumption is all produced units are sold. It may not be true. I can keep it in closing inventory. If there is no demand, I cannot sell. So it will be in the inventory. The next assumption is cost can be classified accurately. Accurately to what? As fixed and variable. That need not be the case. Like some cost may be semi-variable, like electricity charges, which vary in steps. Then constant product mix. So the product mix can change, but in CVP it is assumed to be constant. Volume is the only relevant cost driver. That means in your x-axis, this is your volume. This is the only driver. Along with this, you will find a graph like this or this. Other than volume, there are many other factors also which are involved. For example, technological change or shortage of your manpower. All these are not considered in CVP. So limitation of CVP, these assumptions become the limitations in the CVP analysis. So we will now understand break-even chart under various scenarios. So first let us understand the basic structure of your break-even chart. How does it look? In x-axis, you have output in terms of units produced or units sold. So it's also called as volume axis. Then in y-axis, you have both sales and cost. So this is called sales axis, also cost axis. So in this kind of graph, the fixed cost will look like a horizontal line. Why? Irrespective of your output, as per CVP analysis, the fixed cost does not change. Means it will not vary in the y-axis. It will vary at a single point along the x-axis. So that is your fixed cost line. Then you have a total cost line. It starts at the fixed cost and it slopes upward. So we will look at this. We will look at the graph. So this is your fixed cost line. That means even if my production is 0, which is this point, I have some cost. So that is my fixed cost. And when my production is increasing, my fixed cost remains unchanged. Hence, my total cost line will start from this point only. From this point, it will increase as I produce more and more. Why? I am adding variable cost at each point. So this is how my total cost line will look like. Next, I have sales line. Sales line starts at 0 point. And it increases as I do more production, more sales. And the total cost and total sales will intersect at one point. So this is my break-even point. And when I draw a vertical and horizontal lines from this point, okay, so this is my intersection of break-even units. And if I draw a horizontal line, this is my break-even in terms of sales. So the triangle you are seeing, the green triangle, this is the point where you will make profit. And the blue triangle which you are seeing here, this is the area of making loss. And at break even, you will cover your both fixed and variable cost to recover. So your sales is recovering both your fixed and variable cost. From this point onwards, you will start making incremental profit. This is the basic chart of your break-even. Hope it's clear. Next topic will be, how does the break-even point vary with change in various factors? So first we will take fixed cost. So let's assume that fixed cost is increasing for the case. So when the fixed cost increases, what happens? Your 0 point where the total cost starts, that also goes up in y-axis. And because of this, let's assume all other things remains unchanged. That means your variable cost is not changing, your sales per unit is not changing. The angle of these two are not changing. So because of this, now you are intersecting at a later point. So that means even though your contribution is not affected, what is contribution? Sales per unit minus variable cost per unit. Your contribution is still positive, but now you have to make more contribution to recover this additional fixed cost. Your break-even has gone up, your break-even has increased. The same holds true for reduction in fixed cost. So if fixed cost reduces, break-even comes down. So for a company, lower break-even is always desirable. The company wants to break even early so that they want to make more and more profit. So this is the case with fixed cost changes. Similarly, second scenario is where variable cost per unit changes. So variable cost per unit changes. What is the meaning of it? My variable cost starts at this point and it increases in this fashion. When per unit changes, the slope of this line changes. Now it will be at a higher angle. So that is when the variable cost per unit is increasing. Because of this also, assuming that fixed cost is not changed and sales is not changed, again the break-even point has been shifted to the right side, top and right side. So this means the break-even point has increased. So variable cost has a direct relationship with break-even. If it increases, break-even also increases. If variable cost reduces, break-even also reduces. So this is the second scenario. Third scenario, now we have covered fixed cost and variable cost. Third scenario is sales per unit is changing, same as your variable cost. So my sales line starts at 0 and it increases as my sales volume is increasing. If selling price per unit is increased, again that means the slope of this will increase. So this is your sales S1, this is the sales S2. When the sales line slope is increasing, that means your break even will be, that means you are breaking even earlier. So the desirable thing is increase the sales price per unit, but that is again not in the control of the company, because market dictates the price. If the increased sales price is not accepted by the market, then they have to reduce it. So sales has a inversely proportional relationship with break-even point. That means if selling price per unit increases, break-even reduces, and vice versa. Okay. Then there is a scenario 4 where you have multi-product break-even chart. So let's understand this concept, not as a chart, but let's understand. I have two products, both have per unit selling price, both have per unit variable cost, but they do not have fixed cost. That means the fixed cost is not allocatable to these products separately. For the factory, I have a fixed cost. In this case, how do I calculate my break even for these products? So that is this concept. So I will explain it through a table. So this is my sales, product A, then I have product B. Here I will calculate per unit, then total, per unit, then total, and both of them added together I have a grand total. Variable cost, I can calculate all this. So what I will get? I will get contribution. So contribution I can get per unit, I can get total and grand total also. Next comes your fixed cost. So here fixed cost I cannot assign it here. So that is the situation. I can only subtract it from here. So in this case what I will get? I will get profit. That's fine. But what is the formula for your break even? Break even sales is equal to fixed cost divided by either CPU or PVR. If you want in units, you divide by contribution per unit. So now I want to calculate break even of A. That means I should have a fixed cost of A divided by PVR of A. I do not have fixed cost of A. It is not available. Why it is not available? I have a same single factory. I incur fixed cost at factory level, but I produced two products in the same factory, and I cannot allocate this fixed cost among these products. So this is called multi-product. How to calculate in that case? The weighted average contribution margin I have to take. What is this weighted average? We will see with an example. So instead of break-even units, instead of fixed cost divided by CPU, this will become weighted average CPU. So we will see how to calculate that weighted average CPU. So let's take this question. So this is the illustration number 2. The ABC company sells two types of product A and B. The CMA has prepared following information based on the sales forecast for the period. What details are given? Unit selling price, variable cost, unit contribution, total sales revenue, less total variable cost, contribution to direct and common fixed cost, less direct avoidable fixed cost, then contribution to common fixed cost, less common fixed cost. So finally you will get profit at the final level only. So first is we will understand how many units of A are there. 1200 units. So that data is given here in the header of the table. Okay, 1200 and 600. So that I am recording. Then what is the contribution? Sales minus variable cost. But it is already given. 300 minus 150. 150 is given. 300 minus 150 in case of A, and in case of B it is 200 minus 110. How many units are sold? Totally 1800 units are sold. 1200 of A and 1600 of B. What is the total contribution? So I know unit contribution, I know units. So my total contribution is going to be 1200 into 150. So this is for A. Then 600 into 90. So this is for B. So this is 2,34,000 total contribution. Okay. Direct avoidable fixed cost. So they have already given some portion of the fixed cost which are product specific. These are not common. So this I will deduct, which is this 90,000 plus 27,000. Okay. So this is my allocatable fixed cost. Without this, I have unallocated, which is common fixed cost, which is 39,000. Okay. That means the total fixed cost I have to recover is both allocated plus common. So this is 1,56,000 from this table. So these two are my fixed cost. Now let us see how to calculate. Now I got my numerator for break even. Denominator I have to calculate weighted average contribution per unit, correct? So weighted average contribution per unit is nothing but total contribution by A and B, total units of A and B. So total contribution I have solved, it is 2,34,000. 2,34,000 divided by total unit is 1800 units. So 234 divided by 1800, 130 per unit. Actually, I cannot write it as per unit, per combination of A plus B, because this is weighted average. I cannot write it as per unit. So it is 130. Okay. So now I have got weighted average cost per unit, contribution per unit. Then I have total fixed cost. Now I can calculate what is my break even. Total fixed cost. How much is it? 156. Correct? Divided by 130. I will get 1200 units. So my break even as a combination A plus B. So this is A plus B. A plus B I should produce 1200 unit. But how many of A and how many of B? I don't know. So this I have to recover in the same ratio. Whatever ratio I have, right now I am producing, in the same ratio I have to assign this break even units also. So if I have to make this as a ratio, this is in the ratio 2:1. So 1200, that means A plus B will always be 2A plus 1B. So that means 1200 into 2 by 3 plus 1200 into 1 by 3. So this will be 400 into 2, 800 plus 400. So total is 1200. Now I have to check whether whatever I have done is correct. That means 800 units, if I put it in the statement of marginal costing, well, my profit becomes 0. That is the ultimate test. So let me do that. I will look at this data again. So I will start with contribution only. So contribution 150 contribution. So A 800 and B is 400. So 800 into 150, 1,20,000. 400 into 90. 90 or 110? 90. So 36,000. My total is 1,56,000. Less fixed cost. So in fixed cost you have two heads. One is 1,17,000. Another is 39,000. So profit will be 0. So that means this is my correct break even. What did I do? I modified my break even formula as fixed cost divided by weighted average CPU. How did I calculate weighted average CPU? Contribution of A plus contribution of B divided by units of A plus units of B. And fixed cost, how did I get? allocated fixed cost plus common fixed cost. With this I got my break-even units as 1200, but this comprises of A and B, A plus B, in what ratio? In 2:1 ratio. So when I allocate it, it becomes 800 and 400, and I tested it in the statement of marginal sheet and I got zero profit. That means this is correct.